India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning and welcome to the CNBC-TV18 Motilal Oswal studio. This is Bazaar and I'm Lata Venkatesh. With me is my colleague Rima Tendulkar. Well, it's one of those mornings when trading is going to be thin, when everyone is actually planning what they are going to do tonight. And there is no US trading tomorrow, or rather most markets will not trade tomorrow. So we could have two things, an extremely thin volume trade and therefore a lot of wonky moves because it's easy to move markets today.
Indeed, there's so much festive cheer outside, but when you look at the trading screen, the way we traded yesterday, it's just a bit like, there's fatigue which has crept in, or it's a little lackluster. And even US markets, they were under pressure for the last two trading sessions.
No, I take your point. That will be the inaugural cue that the US markets had a bad 30th. And whether that will cast shadows, between 1 and 1.2%, all the indexes. But my sense is that what impacts Indian markets, or for that matter, emerging markets, are the other two parameters, which is the bond yields and the dollar index. And there, the bond yields have fallen by 8 basis points, which is usually EM positive. I mean, if you're an algo trader with an EM and a US, trading, and the yields fall, then it is normally positive EM. Likewise, dollar index has slipped below the 108 mark. It's a small fall below the 108 mark. By no means is the dollar weak. But what I'm saying is there is no incremental bad news from both these places. So my sense is this is as good a time as any that the bulls can use, or funds can use, institutions can use to prop up NAVs. Simply because the other props are in our favor. The other point I want to note, however, is that the FIs are not out of the market. Yesterday, not only was there a sell of nearly 2,000 crores, 1,890 crores. Do you see the gross volume? Yeah. It's like 17,000 crore sell and some 15,000 crore buy. So it's a substantial 33,000 crore of participation. That's not a small participation.
But yesterday was also the nifty quarterly rebalance. So stocks like NTPC, for instance, saw a little bit of a weight up. There were a lot of adjustments, so that could have impacted volumes yesterday.
Okay. Thanks for that, Rima. But my sole point is that the cat is not quite away. Nevertheless, I think today is going to be a thin trading day, and I expect a lot of green on the screen. I'm dressed that way simply because I think there will be at least NAV management today.
Okay, but just a quick recap then of how we fared yesterday. Well, yesterday was a bit of a disappointing session because it showed promise. There was an intraday surge, but at elevated levels in the second half of the trading session, selling pressure kicked in. The Nifty ultimately ended at 23,644, a cut of about 0.7% below the 200-day moving average. But just take a look at the key levels over the last couple of days. Now, yesterday, the Nifty made an intraday low of 23,599. This is lower than the lows that we've seen over the last 5 trading sessions. And the high yesterday, 23,915, pretty much coincides with Friday's high. So now the boundary for the market just over the near term is 23,900 on the way up, yesterday's intraday high, and on the way down, 23,600 thereabout. And yes, while the FI selling did pick up yesterday, as Lata said, nearly 1,900 crores sold in the cash market, the DIIs did buy a little bit more. So 21,073 crore was bought by the DIIs in the cash market. The China manufacturing PMI data is also out. So just a quick word on that. It's expanded, which is positive, 50.1 in the prior month, but this is lower than expectations of 50.3. So clearly the stimulus, whatever measures they've announced, is not enough. So the expansion in China is not keeping pace with the expectations. So that's a bit, and we should pull up the Asian markets. Very, very quiet moves so far.
Now, I take your point on that. Let me put just one more worry on the table. The Reserve Bank's financial stability report. Let me first tell you that the financial stability report is intended to check out how banks and financial institutions will do when they are under stress. But it doesn't mean that that is the base case. It is an extreme case.
So it's like a stress test?
Yes, it is a stress test.
Okay.
So, basically, suppose cryptos were to fail. Suppose there is a cyber security risk. Suppose there is a big, bad loan, or there is a big event in global markets. The over leverage that you see in global markets suddenly turns bad. You imagine all these scenarios and then say that loans can, kind of fall. But what the RBI is saying is, even with extreme stress scenarios, Indian banks will not go under. Even if the top 5 banks have this level of stress, even then no bank fails. So actually there is a positive in the report they are giving, and all these are scenarios. They are not exactly what the government or RBI expects, because they have not even lowered their GDP forecast. The GDP forecast is as of December 9th, when they said 6.6. So they're not expecting it. It is a rosy picture as far as the Indian growth is concerned. I mean, 6.6 is bad compared to 7, but it's a good rate of growth to work with. And therefore, we must take these scenarios with a pinch. The only part I would worry about is where they are talking about unsecured loans.
But that's not new to the market, right? We've been flagging it off. Corporates too have been talking about the stress in the unsecured portion, in the unsecured portfolio. So in that sense, it's not that it's a new, fresh negative development for the markets, a new unknown.
No. When Reserve Bank reiterates it, the market worries a bit. Yes, you worried us. Last November, the risk weights on unsecured loans were raised to pre-COVID levels. So, okay, they do say that the percentage of unsecured loan has slowed. But they do point out that private banks are showing high level of write-offs. And there is increasing incidence of one person having multiple loans. I mean, he has a credit card loan and perhaps a personal loan. And he's also a person servicing an auto loan and a car loan. So that worry is very,
documented by. All right, let's take stock then of the way forward, how the global cues are stacking up as we head into next year. Rupal Bhanchali, Chief Investment Officer, Global Equities at Double Duty Money Management, now joins us on the show. Rupal, it's so great to have you on the final trading day of 2024. And what a year it's been. It's blown past everyone's expectations, particularly the US markets. In a span of 2 years, the S&P 500 is now up 50%. Who would have thought that? But now, given that, given where we're starting off, what do you expect in 2025, the first half and second half?
It's really hard to make predictions. I prefer to prepare rather than predict. And I think what I would do to prepare is to watch the bond markets very carefully, because if you notice, the 10-year bond rate in the US has shot up quite a bit. And in fact, while equity markets perform very well, the bond markets did very poorly. And I think it's really behooves equity investors to take their cues from the 10-year treasuries, which is about 4.6%. If you look at the leveraged loan market and you look at the consumer credit market in the US, it is already showing signs of stress. The default rates are spiking up, and this does not bode well. Whenever risk appetite reduces, equity markets do poorly. So unfortunately, I don't have a very positive view on market performance next year, whether it's the first half or the second half. I think a lot of the stresses that have been hidden from view because of the obsession with AI and other technological improvements, we are ignoring a lot of the challenging news that's coming out of markets.
Okay, well, that's well put, Rupal. In fact, we were just discussing, Rima and I, about similar fears that the Reserve Bank has expressed in its financial stability report yesterday about the Indian consumer, some of them being, or a rising number being over-leveraged. But before I come to that, let me parse the other statements that you made, that the bond yields are rising and the equity markets need to worry about that. Why does that worry you?
Well, I think the bond market vigilantes, like they did in the UK, are expressing their views in the US that they are worried about long-term inflation. I think we've been coming off a period of excessive stimulus, whether it was monetary stimulus post-GFC or COVID-related stimulus, in the more recent years. Worldwide, we've had a lot of money being given to corporates or to consumers. And that excess, has a price to pay. Inflation is not coming under control. And that's what the bond market is worried about, that with the incoming presidency, that those deficits will not be addressed. This is true in Brazil as much as it is in the US. So I don't want to single out any particular country. The French market is facing the same conundrum. And so I think it's a global phenomenon. And I think it'll manifest itself in people charging a higher risk premium in markets.
Okay. Rupal, at the moment, in spite, these risks are known. I mean, we have been looking at the bond markets day in and day out, hour in and hour out. But nevertheless, people are going on piling their savings into the Nvidias or to the Magnificent Seven or even lower down. Would you not do that as a chief investment officer? Wouldn't you still continue to believe that a large number of US stocks are still doing well, that they will probably get tax cuts and their EPSs may actually increase in 2025?
Actually, if you look at the budget deficit, I think the market is saying the scope for tax cuts is quite limited.
Okay.
But besides that, I think your larger question is, how would I invest in markets as a CIO? I think there are investors who play momentum and there are investors who play fundamentals. I am the latter. So I totally understand your point that, when the market is running away from you, there is a feeling of missing out, the classic FOMO. I guess I don't feel that because I've been in markets for 30 years. And I know the overhang and the after shock that these sorts of bubbles can create. Ultimately, valuations matter in pricing an asset, and valuations act as a gravitational force down. We are all trying to be astronauts, and I think we need to come down to earth and recognize that we need to walk, and we won't have artificial support allowing us to fly.
Fair point. So what would be your picks at this point in time? Which markets or which kind of stocks, sectors?
Ironically, for all my concerns about the the credit sector, credit markets that I just expressed, I actually think banks in emerging markets are a very good way to invest, both for capital appreciation, because they're quite undervalued when you look at it from a price to book or a price to earnings perspective, and also from a credit quality perspective. Banks actually have become far more circumspect since the GFC, and they've actually gotten rid of a lot of risk on the balance sheet, and they're quite well capitalized. I'm not saying every bank, but I think in emerging markets, the real rate of interest is quite high. And I find blue chip banks, leading banks in the countries, have actually sold off or underperformed as people overinvest in technology. And some of the names I would mention, certainly in Latin America, which I think is one of the cheapest markets in the world, you will find banks like Banorte in Mexico or Credit Corp in Peru, and many other banks of that ilk. In fact, coming home to India, as you well know, HDFC Bank, one of the most blue chip banks in this country, has underperformed. And the reason they've underperformed is because they've taken it on their chin to engage in better risk management. They are one of the few banks that is refusing to grow their loan book in the unsecured consumer market and actually have reduced it. Now, that hurts margins in the short run because consumer credit unsecured is one of the highest margin loans you can make. But I think they are showing circumspection, especially because of this RBI report and other things perhaps they are seeing in the market. I would bet with a smart money like HDFC Bank and actually prefer to not take risk today so that you can actually take it tomorrow when you're paid to take it. So these are some of the opportunities that I find interesting in the markets. There are many others, of course, but I thought the banking sector globally, with interest rates, being high, remaining high, are actually very positive for their spreads.
So HDFC Bank is one of your top ideas for India. What else, Rupal, do you like?
Not much else. I'm an intrinsic value investor, and I think I've been on your show for many years, and I actually have not participated in this Indian rally, which has of course gone on for a multi-year period. But I think as long-term investors, we sometimes know when you should lose the battle to win the war. And in order to win the war, sometimes you need to give up on short-term gains and avoid long-term pain, which is, massive corrections. I've been through many bear markets. And while, this one has eluded one for a long time, and I'm not alone in my view, so I'm hardly non-consensus here, I think there comes a time when you have to look at the data. So let me give you one point you've made is, what's different now? Because these concerns have been around for a long time. I think the difference now is you're looking at the data, you're seeing the default rate in the most vulnerable end of the market, which is the leverage loan market and the unsecured consumer credit market, deteriorate, not just in India, but even in the US. The other point I would make is look at the profit warnings that have come out. They've all come out from consumer goods companies. Fast moving consumer goods companies have profit warnings in India. They've had profit warnings in the US. They've had profit warnings globally. Now, whether it's a low end consumer in the discount store market, which emerged initially in the US, or it is the high end consumer in the luxury goods market, which is either unwilling or unable to spend, now it has seeped into the mid end consumer. So worldwide, you're seeing profits, being eroded because the pricing power that we thought consumer goods companies had are actually not playing out in practice. So I think inflation, finally is hurting the pocketbook in a way that is now affecting corporate profits. I think that's why the day of reckoning is sooner rather than later.
Okay, that sounds dire, Rupal. But, we had fund managers for year-end chats, and one of them told us that that's why he will buy FMCG. He thought that there was sufficient scare around them, like HDFC Bank. They're also one of the underperformers of 2024. So buy because the market fears. Is that not a strategy?
I'm not afraid to go against the grain of the market momentum and actually lean into fear, because that's when you get some opportunity. Unfortunately, these stocks have been so expensive. They've priced in so much growth that the valuations are still not compelling. Unlike in the case of the banking sector, not necessarily in HDFC Bank, but some of the other banks I mentioned, you can get dividend yields of between 5 to 8%. That is sufficient rate of return on the dividend alone that I don't even have to worry too much about capital appreciation on a long run basis. Not to mention these are ROEs of 15-20% on very low leverage. So I think the FMCG sector has yet not offered compelling valuations globally, which is why I'm staying away. But I'm not averse to it. They're getting close to that level.
Okay, that's good to hear. Well, let me just be the devil's advocate. In this case, the devil is the bull. We had big fears 2 years ago and even last year that the US is going to end in a recession or going to see a recession as the Fed starts hiking rates. That didn't happen. Look at the US GDP. I mean, it's a picture of strength. So, can we be discussing similar fears at the end of the 2025 as well? Yes, there will be fears, over leverage, likelihood of inflation, but nevertheless, good corporate earnings. Is that a possibility?
So again, you're absolutely right. Many of us have been proven wrong in our assessments because some of the leading indicators, which was an inverted yield curve, which has traditionally been a very good marker of a recession, frankly, did not play out. I think a lot of this has to do with excessive fiscal stimulus. In the short run, you can prime the economy in ways and at a magnitude that is very hard to ignore in the short run. But in the long run, it catches up with you. This is happening in major markets like France. It has happened in the UK. Brazil, the real has actually collapsed because the fiscal deficit is out of control. I think the US is not far behind. So this is why I think the day of reckoning is sooner rather than later. That said, as investors, our job is to make money for our investors and to avoid areas where you're likely to lose it. And so there is opportunity in the market. It's a question of finding it. Another example is the tire industry. The automotive sector has been hit hard, again, as a consumer is avoiding durable goods as much as they're avoiding, fast-moving consumer goods. And in the durable sector, the automotive sector, the tire industry tends to be more resilient and is trading at very attractive valuations. And they are big beneficiaries of some of these trends that we're talking about, whether it's, move to EV, a move to larger vehicles, which everybody seems to enjoy, SUVs as opposed to compact cars. It's also playing on the mining tire industry because, mines tend to be very far from the ports and you need heavy truck and therefore truck tires, to ply those goods to where they're needed. So I think there are opportunities in the market. They're just not the obvious ones. And so we are fully invested in our clients' portfolios. The question is, are they the popular stocks or are they the compelling stocks? We would choose the latter, even if it means sacrificing near-term gains.
Okay. Well, I think I know the answer to what I'm going to ask you, but nevertheless, since this is the talking point here, the big winner, we don't have a magnificent 7, but we've had these wonderful e-commerce stocks, the Zomatos, the Zaggles, Nykas, Swiggies, which have done very well. And, we have some of these, Paytm, PB Fintech, which have kind of fallen and come up. Basically, the e-commerce stocks. Then we have the EMS stocks, the electronic manufacturing. India is new into this, global value chain theme. And some of those Dixons, Canes, all those smaller stocks have done very well. Very well, as in, 200% gains.
No, because I'm very focused on making sure I trade true to my discipline. I have been to this movie before in many arguments being made there and 10 years ago. And we've all seen how dramatically China. So it doesn't take a lot, for these fortunes to reverse course. And you want to be very careful as to what can be excruciatingly painful. And if investors don't know what the intrinsic value of a business is, they will not know what decision to make when these companies start going down.
Okay.
I think you need to getting. And I find a lot of investors are investing based on flows rather than fundamentals. I see people talk about, what the compelling opportunity is versus what the growth opportunity is. Growth stocks have a very potentially uncertain future when you go further out. And a lot of the growth rates, that you have to assume are very far out in the future. And the further out they are, the higher the risk premium you should charge rather than a lower one. And so I think this argument for growth stocks is sort of upside down. Investors are investing them because of the growth. And I would argue as a value investor, a bird in hand is worth more than 2 in the bush. And so you should not overpay for something too far out because a lot of things can change in the future. And if you put your down payment in a very large way upfront, then you're the one who's going to lose. And the other side who's already taken their payment upfront does not have much to risk.
Okay. Rupal Bhansali, it was a pleasure speaking with you, and it's always good to know that there are very cautious and careful fund managers out there. I'm sure many of your investors will, in the end, actually thank you for taking such good care of their money. Thank you very much for joining us, and have a brilliant 2025 yourself.
Okay,
And
moving on.
Happy New Year to you too.
Happy New Year. Happy New Year, and wish you a wonderful 2025. But now let's tell our viewers all the corporate interactions that we've lined up on the show today. So first up, at 8:30, we've got Amnish Agarwal of Prabhudas Leeladhar joining in for some fundamental stock analysis. At 9 a.m., we have Manik Taneja of Axis Capital, and he will talk about the key trends in IT sector. 9:20, Mihir Vora of Trust Mutual Fund will be a market master. 9:30, the management of Shriram Finance will be with us to discuss dispersal, loan growth and outlook for next year. And following that, Vinity Saraf Mutreja of Vinity Organics will be chatting with us at 9:40. A little later at 9:50, Satish Vagh of Supriya Life Sciences will join in to talk about the second half of the year. And towards the end of the show, it's always our special segment, It's the Economy. We'll connect with Mahesh Vyas of Center for Monitoring the Indian Economy, CMIE, and Dharmakirti Joshi of CRISIL to discuss if the capex cycle has taken off.
Okay, so that's what we've lined up for you. It's time for a quick break, but we have lots of stock-specific action to take you through today. We will do it in just a bit in our special segment, Top 10. We are going to look at Hindalco, Lupin, ITC, Mazgon Dock, RVNL, Shriram Properties, ONGC and Oil India. These are the stocks that are on our radar for positive news flow. And bank stocks and easy trip planners are on our radar for likely negative news in these stocks.
Welcome back. The Gift Nifty is suggesting a negative start. So after losing nearly 160 points, 170 points yesterday, the implied open suggests another 150-point downtick. But let's get to the stocks. Our research team is standing by with CNBC TV18's list of top stocks for the day. And first up, it's Abhishek joining in on banks. Abhishek.
Well, RBI has given out their FSR, that is a feasibility study report that they have seen. They have mentioned that banks have strong profitability, declining NPAs and sufficient capital adequacy ratio and liquidity buffers as well. So the return on asset and return on equity are at decadal high, with gross NPA being at decadal low or a 12-year low. So NBFCs remain healthy with sizable capital buffers, a robust interest margin, that is net interest margin, as well as earnings and improving asset quality. Both are augmenting well for them. Provision coverage ratio stands at 77% as of September 2024. The key worry that they have cited in their FSR is that nearly half the borrowers availing credit and personal loans have also another retail loan which is of the higher ticket size, like housing loans or vehicle loans to say. So this is an area of concern, and also another area of concern is the high write-off seen in the private sector banks. So this could be partially masking the underwriting standards that private banks have. Just to highlight our viewers, much of the write-offs that have happened over the last 2 quarters for private banks is in unsecured portfolio like microfinance, credit card and personal loan, where the recovery rate is really low and you cannot have recovery over there. Back to you.
Point taken, Abhishek. Extremely well summarized that those are specifically the fears of the Reserve Bank, the high write-offs and the higher rate of NPAs in unsecured loans. Overall, GNPA is not much, but in that there is an overwhelming share of unsecured loans going bad, and that's the Reserve Bank's only worry. But I want to once again stress that this is a stress test report, so all the numbers should not be taken as negative news. These are scenarios. If these negative things happened, then things could go bad. But I take Abhishek's point entirely on the write-offs and the unsecured loans. Well, let's go to Vivek. You have news on Hindalco, Vivek.
That's right. Good morning. Hindalco is in focus. The company has received allotment from the government. This is for the Meenakshi coal mine in Odisha. Meenakshi coal mine, remember, is a fully explored block with a peak rated capacity of close to 12 million tons per annum, and it has a geological reserves of up to 285 metric tons. Now, what is it that the company is saying, which is positive news? They say that the allocation of coal mine rights actually aligns with the company's strategy to reduce operating costs and also boost energy self-sufficiency. This will also help reduce the dependence that the company currently has on auction as well as linkage coal, which is almost 40% higher than Meenakshi coal mine. So overall, a positive development with the allotment of the Meenakshi coal mine as far as Hindalco is concerned.
Thank you very much for that. There's an important news and update coming through on Lupin. Vinny joins in for more on that, and even on ITC. Vinny.
Good morning. So yes, Lupin, couple of news flows that we're seeing coming in. One, yesterday there was an announcement that came in that Lupin has acquired an anti-diabetic medicine, Hamacillin, which is from Eli Lilly. It is for the India business. Now this becomes a good addition to the diabetes portfolio. It's for the treatment of type 1 as well as type 2 diabetes to improve blood sugar controls. Now, obviously, do not forget, Lupin's diabetes portfolio has grown 19% in Q2 FY25 on a year-on-year basis versus the industry, which grew at around 9%. So yes, an improvement in terms of the portfolio. Other than that, Lupin, one more news flow has come in because there was a case that was going on between Teva as well as Amneal in the US court, where they had filed a petition now for en banca hearing of this case. Means all the judges will hear this case together. This means that there is going to be a delay in terms of a launch coming in from Amneal in terms of their drug, which was GoPro Air, which was expected to be launched somewhere in Q4 FY25, around that level, around that time. So now this delay turns out to be a positive for Lupin, because that means that they could, the sales that are coming in for them for this drug still continues, and the decline that analysts were expecting from this drug will maybe get delayed. So a positive on that front for Lupin. Other than that, we have ITC that's going to be in focus, and we're expecting green here as well, because ITC Hotels demerger, the X date is going to be 6th of Jan 2025, while books are going to be separated from 1st of Jan, that's tomorrow. So keep an eye out on this, because one shareholder of ITC 10 shares, if they're holding in ITC, will get 1 share of ITC Hotels. This is going to be expected to take place, the listing of ITC Hotels, within 60 days from now on, from the NCLT order. And Hotels arm will also receive 1,500 crore rupees cash in this demerger to continue their business, as well as there's going to be a division in terms of properties. But 6 Jan is the record date where we will see X of ITC Hotel, that ITC will start trading in terms of shares.
Okay, thank you very much for that, Vinny. You know, ITC is going to be the talking point today. Because you look at the way Indian Hotels is done.
Yeah.
So if ITC Hotels is going to bank on that, even if it does even 90% of that or 80% of that, you have a winner. Part and gave it separately, it will probably fly. That would be expectations, and that for the till they reach 200 or something. It's like fairly aggressive plans. So I think the stock of the day. Let's get to the another big stock of the day. Reasons Easy My Trip. Vivek is going to tell you all the news in that stock.
Well, that's right. So Ease My Trip is in focus. Now, as per the term sheet that CNBC-TV18 sourced, what we understand is that one of the promoters, Nishant Pitti, remember, he had earlier sold close to 14% stake in September. Now, once again, we understand that he's looking to sell close to 14% stake. This particular stake sale is likely to be done via the block deal. And we also understand that this particular size of the block deal is at close to 780 crore. What is slightly concerning, the floor price, 15.6 rupees a share, almost a 9% discount. This comes immediately on the heels of the September stake sale. Also remember, today being the last day of the quarter, this also is the day in which the insiders can actually go ahead and sell their shares. So that's also one thing that we need to keep in mind. So overall, 50 crore shares that will be sold. 15.6 rupees a share is the base price at which the deal is likely to take place. And remember, last time after this particular deal took place, the stock saw quite a bit of a sharp negative reaction, a bit of a bounce the next day, and again hit 2 lower circles. It will be interesting to see how Ease My Trip behaves if this particular block deal goes through.
Thank you very much for that. That'll be the other stock of the day. And Upasana joins in for some more news. Upasana.
Good morning. First up, let me start with Mazgaon Dock. Now, Ministry of Defence has signed a contract valued at 1,990 crores with the company, which is basically for the construction of air-independent propulsion system, that is AIP system, which is mainly technology that allows submarines to stay underwater for longer. Now, this AIP system was built by DRDO and the units will be built by Mazgaon Dock. Now, next up is RVNL. Even this stock will remain in focus on the back of the order win. The company bags 137 crore order from Central Railway for Bhusawal Khandwa project. Hence, even this stock will be in focus. And lastly, Shriram Properties is also on our radar as the company announced strategic sale of 3.9 crore land parcel in Chennai to a prominent healthcare and educational group in South India. Also, the company signed an agreement for divestment of securities held in its arm, that is SPL Shelters, for 93 crores. Hence, all these stocks will remain on our radar today.
Okay, that's good to hear. Thank you very much, Upasana, for giving us a brief on so many stocks. But there are 2 more stocks that should be on your radar, is what Manisha Gupta thinks. Manisha, tell us, why should we be watching ONGC and OIL India?
Oh, well, yes, because the crude oil prices have continued to gain in the last couple of days, with thin trades and last few hours as we finish 2024. But even with that, the price moves clearly have been exaggerated. We are headed for a very small annual decline when it comes to the crude oil prices. 0.5% down for WTI and 2.5% down for Brent is how this year seems to be closing as of now. But with the overnight gains, we've gained up a bit of a ground. We're trading at a 5-week highs right now. The crude prices have gained up by 5% in the last 1 month as well. The support comes in from 3 factors. One, there is decline in the U.S. inventories. Second, there is colder weather in U.S. and Europe, and there is forecast of colder weather as well. So that means the natural gas, the crude oil product, will see higher demand. Third, the market is looking at hopes of economic stimulus coming in from China. So these are the 3 factors that seem to be supporting crude oil prices right now. So we are back above 71 for WTI and 74 is holding for Brent as well.
Thank you very much for that. A quick recap then of the top stocks. Stocks with positive news flow are Hindalco, Lupin, ITC, Mazgaon Docks, RVNL, Shriram Properties, ONGC, Oil India. Stocks with negative news flow are banks and Easy Trip Planners. We will slip into a break. On the other side, we'll invite Amnish Agarwal, Head of Research at Prabhudas Leeladhar, for some fundamental stock analysis. Stay tuned.
Welcome back to Bazaar Morning Call. It's that time of the day when we have our first guest to understand the micros. And today there are lots of stocks to discuss. Joining us now is Amnish Agarwal. Amnish, good morning and thank you very much. But before I shoot my first question to you, can we just get the key details of the Reserve Bank's financial stability report? Because that is going to be our first question. They released what is called the FSR last evening, and that is giving us some warning about unsecured loans. So let me just listen in to my colleague Ritu Singh, who filed the story.
I'll start with some of the key risk areas that RBI has flagged off in the financial stability report, starting with the retail loan segment, where RBI points out that while the retail segment gross NPAs at 1.2% are stable so far, the bad loans in the unsecured segment are higher at 1.7%, with more than half of retail loan slippages across the system coming from the unsecured segment. But what's more concerning, says RBI, is the sharp rise in retail loan write-offs, particularly by private sector banks, which could be masking deeper issues like bad asset quality and weaker underwriting standards. Microfinance is another area under strain. Stress assets, those overdue between 31 and 180 days, more than doubled in just 6 months, rising to 4.3% as of September. And borrower indebtedness is also climbing. RBI says nearly 6% of borrowers now have loans from 4 or more lenders at a time, compared to just 3.6% 3 years ago. And loan sizes have also ballooned, up 43% in the last 3 years on average. In consumer credit, the report says around half of credit card and personal loan borrowers are juggling another high-ticket loan. So smaller personal loans are putting secured loans, which are larger as well, at risk, because keep in mind, a default in any loan category results in the loans of the same borrower being treated as an NPA as well. Now, if we look at RBI's stress test results, which are not projections but rather outcomes that are based on hypothetical stress scenarios, they suggest gross NPAs could more than double from 2.6% as of September to 5.3% by March of 2026 in the worst case adverse scenario, with public sector banks remaining most vulnerable. But even in the base case, RBI says NPAs are expected to rise in the coming year as per the stress test. Now, capital adequacy remains resilient at 16.6%, but it could drop all the way to 14.3% under one of the stress test scenarios. As for NBFCs, a stress test showed that gross NPAs could rise sharply from 2.9% to 6% under high risk, while capital adequacy could fall to 20.2%. Alarmingly, 15 NBFCs could fail to meet the minimum capital adequacy ratio if severe risks materialize. So overall, the report paints a mixed picture. The system shows resilience on one hand, but on the other, vulnerabilities are emerging across retail, microfinance and consumer credit.
That was Ritu Singh, who filed the story yesterday. Amnish, the latter part of what Ritu is saying is only if there is stress, if something happens globally. But in the earlier part, as Ritu delineated, RBI seems to be worrying about a higher leverage, more people having 4 loans per head, and the size also ballooning by 43%. Any worries? How would you approach the banking and NBFC sector?
Yeah, hi Lata. You see, these some of the things which have been highlighted. They are not, I would say, entirely new. Well, if you look at, say, last couple of years in particular, there have been news from time to time that the unsecured lending in particular can come under pressure. And that is exactly what this report is highlighting. Now, the second part is on the microfinance loan. If you look at all the MFI and the related, whether it is an IndusInd Bank or some of the standalone MFIs, so I think they are actually witnessing sharp increase in the NPAs in the last, say, few months. So I think a lot of it is already there. But having said that, the kind of, you can say, pressure which is currently being witnessed with many of the consumers more at the low to lower middle end having multiple loans and all, I think that is something which is a reality. And I think it is going to play out over the next, say, couple of quarters. Now, having said that, my sense is that maybe you can say this quarter and at maximum couple of quarters more, the inflow of the worst news that would be over. So in terms of stock price, if you look at all the segments, most of these stocks in these segments, whether these are, you can say, the banks related to that or some of these MFIs, I think they have either bottomed out or they may be close to bottoming out in the next, say, 3 or 4 months. So I would say in certain segments, the growth rates have come off. Say, for example, whether it is, you can say, NBFCs, which are focused on commercial vehicles. So the growth rates might remain nimble for some time, but a lot of these negative news might have already been factored into the stock price of stock companies.
Amnish, hi. ITC hotels, that's going to be the talking point. The development overnight is that the record date has now been announced, which is 6th of Jan. Now, just for our viewers to put on board the numbers of ITC versus CN Indian Hotels. Now, ITC's revenues in FY24 were about 3,100 crore rupees, while Indian Hotels was 6,700 crore rupees, so less than half its size. And margins for the two are comparable at close to about 32-34% roughly. So margins are comparable. But ITC Hotels, Amnish, has set a fairly ambitious target. They have 140 hotels currently, and I think they have indicated that by 2030, they would like to have 200 hotels. From 140, they want to make it 200 hotels by 2030. Have you done the analysis of ITC hotels? What would be the appropriate value? And between Indian hotels and now potentially ITC hotels, which one should retail shareholders look at?
Okay, hi. You see, when it comes to ITC hotels, it's the second largest chain in the country. Now, we have been valuing this company as a part of ITC Limited, where we have assigned a value of, say, roughly around 27-28 rupees per share. Or you can presume anywhere between 25 to 30 rupees per share is the value which comes for the ITC shareholders. Now, if you then translate into the standalone, you can say entity, which would be having close to, say, I think some 125, 126 crore shares. So that should translate to something like, you can say 200 to 220 to 230 rupees per share. But I think once this company is listed separately, then I think that the dynamics would be different. And I think it could command a reasonably good valuations because the size is there, the profitability is there, and they will also be giving it enough cash to grow for the next few years. And the hotel industry currently is doing well. Your ARRs are moving up, the occupancies are good. So, and I think that given the state in which the hotel industry is currently, I think the listing of the ITC should be good and it should really unlock value for shareholders.
The company said that they'll be transferring 1,500 crore of cash from ITC to ITC hotels to begin with.
Yeah, so, you know, Amnish, since you have now a formidable competitor for Indian hotels, would you, chip off something from Indian hotels, reduce your positions or at least reduce your price targets?
I don't think it's going to play out like that because the ITC hotels was always a very formidable competitor when it comes to business. But when it comes to, you can say, now the only difference is that it will be a separately listed company. Now, when it's a listed company, actually it gives a more option to the investors. Because if you look at all the hotel companies which are listed, for example, your EIH is there, ITC is there, and then the host of, you can say, mid-cap names are there. So to that extent, I think the second largest company getting listed separately is positive. Now, I don't think that necessarily there would be, you can say, something which would, yes, there will be, I would say, renewed interest as far as the ITC stock of the hotel is concerned. However, having said that, I don't rule out that 2 months down the line or when, I think at the earliest possible opportunity, your BAT will come and try to sell their holding in ITC because ITC hotels is being demerged as a, you can say, mirror image of ITC Limited. Okay, and BAT would be having roughly around, say, if you look at, say, 60%, 25% of that, around, say, roughly around 15% of holding will be with BAT. And I think BAT would be looking at exiting this company sooner or later. So I think that will actually also provide a very good base for the institutions to take or increase the shareholding in ITC. But nonetheless, I think it is going to be quite interesting. And the way the hotel industry is, I think, doing at present, ITC hotels will provide another opportunity for the investors to participate in the growth in this industry.
You know, the kind of wealth Indian hotels has created, 100% in 2024 and 400% in the last 3 years. So the hospitality sector in India has really taken off post-COVID. Amnish, stay on. Need to get into a break. On the other side, we'll talk technicals. We'll also invite Sudarshan Sukhani and Shrikant Chauhan on our show.
Welcome back. Amnish is still with us, but we have to look at our technical moves as well today. And of course, today being the last day of the year, of the quarter, whether there would be also some, moving around to manage NAVs. Sudarshan Sukhani and Shrikant Chauhan, our technical experts, are joining us for some trading strategies. Good morning, Sudarshan. What do you think today? Yesterday, we were taken for a cool ride with the markets going up and down. But is there a long trade today?
Good morning, Lata. No, unfortunately not. The chances are that we'll break down from the support levels of 23,600 today, right at the open. Now the markets can do anything after that. We can go down and then finally have a relief rally or do whatever else. But on the charts, on the technicals, once a significant support is broken, as it will be today, most likely, then the long trade is gone. Now we'll have to wait patiently for new signals, essentially the markets to stop falling, move sideways, build a new base. The entire process that was done a few days ago, has to be repeated. So today there is no trade in the Nifty. It's much better to focus on stocks. If you have long positions, you need to exit on small rallies.
Okay. Oh, that's useful advice. Shrikant, how would you trade the indexes?
Good morning, Lata. Good morning, everyone. I think, the markets are clearly forming lower top, lower bottom series. It is sustaining comfortably below the 200-day simple moving average, which is a cause of concern. And maybe after opening to the levels of 23,500, where there is good amount of put writing, we could see some maybe relief rally in the market. But broadly, we are of the view that the markets are again heading towards the levels of 23,250, which was its previous lowest level. So I'm of the view that in these markets, we need to be very, very stock specific instead of taking any specific weight on the indices.
Okay, so everyone's playing caution today. Thanks much, Shrikant. Now let's get to specific stock strategies. Sudarshan, trading short or trading long?
The trades are still on the long side for stocks because there are stocks, there's a large universe of stocks, and some stocks are doing better than the market. So the focus should be on those stocks. Going short is not easy because we are in a very long-term bull market. Short selling causes problems. So I have on the long side Balkrishna Industries. Now my initial stop is 28.25, but given the chances of a gap down, traders will have to adjust these stops. So Balkrishna Industries is a buy. My only intraday short is Navin Fluorine with a stop above 32.50. Again, there are two pharma stocks, Cipla and Laurus Labs. Both are buying opportunities, and the dip could actually give us better opportunity. So Cipla with a stop under 14.95 and Laurus Labs buying with a stop under 5.80. Adjust the stops according to the market's open.
Got that. Shrikant, what are your individual stock picks?
I think in this type of markets, we need to be short on those stocks which are expensive in terms of valuations, as well as they are falling from their immediate highs. So in that specifically, we are technically bearish on Trent, which is currently around 7,000 levels. It has left almost all its important short-term averages, and it closed below those levels. So from here, the stock can fall to the next levels of maybe 6,700 or 6,650 in the near term. So it's a short at current levels. Trent at 6,950, 7,000 levels with a stop loss close to 7,100. And the other stock on which we are specifically bullish, or maybe on the sector on which we are bullish, is from the pharma space. Aurobindo Pharma looks good. Currently, it is around 1300 levels. And if we see the overall performance of pharma stocks, then they are relatively doing much better as compared to other stocks. So, Aurobindo Pharma looks good at current levels with a target close to 1400, 1430. And we can keep stop loss somewhere close to 1270 for the same.
Okay. Well, we have more questions for both of you, but we have to get into a mandatory break. Shrikant and Sudarshan, do stay on. We'll come back to you at 9:10. Quick break, and we're going to come back. We will have the pre-opening rates.
Welcome back. You're watching Open Exchange, Bazaar Open Exchange, live from the CNBC-TV18 Motilal Oswal studio. It's time now to invite Soni Patnaik from JM Financial Services for a few F&O trading strategies. Hi, Soni. Good morning. So, what do you have for us?
Hi, good morning, Reema and Lata. Thank you for having me on your show. So I think if we look at the indices, maybe Nifty can break down, but if we look at for Bank Nifty, it is quite at a crucial level. Bank Nifty is just holding above its 200 exponential moving average. And in any latest sell-off scenario, we've seen it defending those levels. So maybe small risk traders can look forward to buying this declines on Bank Nifty if it opens around a 50,600, 50,500 level, which is exactly where the 200 exponential moving average is placed. If it bounces back from those levels, it can again retest the 51,000, 51,200. The strategy for index would be to buy on declines, but to hedge the positions with the buying of a 50,000 put option. So this is strictly for Bank Nifty. I think for Nifty, we'll have to wait and watch and get into stock-specific action. For stock-specific, I've got three ideas. One would be a buy in Indian hotels, which has seen very aggressive long built-up position yesterday. So one can buy Indian hotels on declines up to 880, keeping a stop loss of 850 and a target of 920 to 940 can be seen. The second buy idea is for Polycab, which has seen very strong short covering yesterday, and it has been holding strongly above 7,200 mark. So one can buy Polycab on small declines up to 7,200, keeping a stop loss of 7,140 and a target of 7,400, 7,450 can be seen. And the third trading idea is a sell trade for ABB. Now, ABB has been seeing continuous downside and has broken major support levels. So one can sell ABB futures with a stop loss of 6,850 and a target of 6,600 to 6,540.
Okay. That's a lot of stocks to munch over. Thank you very much indeed, Soni, for joining us. And have a great 2025. We don't speak to you. Amnish Agarwal is still with us. Amnish, there are two stocks in the news which we desperately want to ask you. One is Adani Enterprises moving out of Adani Wilmar. Does that make any of them attractive to you? And the other one is Easy My Trip, if you are looking at that stock.
Okay, see, Easy My Trip, I don't have, you can say, much hang on. As far as your Adani Wilmar and Adani Enterprise is concerned, I think in a way it is positive for both the companies. If you look at, say, Adani Enterprise, then actually they will get an inflow of close to $2 billion, which I think could be very handy for them because they are incubating a lot of new businesses. They are entering into a lot of segments. And I think a lot of, you can say, lot of requirements of funding the capex will be taken care of by that, at least in the near term. So that is definitely a positive. Now, when it comes to Adani Wilmar, you see, the main thing is that Adani Group is going more on the, I would say, if you look at their forays, it's more on, you can say, they are into ports, they are into power, and they are into realty and various other infrastructure segments. So Adani Wilmar was the only, you can say, JV which was on the consumer side, and that too in the more commoditized segments where the margin trajectory as such is low. Now with Wilmar, which is actually, you can say, Asia-based MNC taking it over, I think the focus will be slightly more in any which ways. As per our understanding, most of the operations they were being undertaken by Wilmar only. So that I think that focus will also come on that. I think over a period of time, I think it's a win-win situation for both the companies actually.
Just in the near term, Wilmar will face a supply overhang. as one of the promoters looks to sell that 13% stake to bring it down to 75%. So there will be that supply overhang. But Amnish, thank you very much for joining us today and wish you a very, very happy new year. Look forward to chatting with you more often in 2025. But now let's talk about the IT sector. Now, yesterday it was in the news because the President-elect Donald Trump has backed the use of H-1B visa, saying he fully backs the program for foreign tech workers. He says it's a great program. And he, remember, was once opposed to H-1B visas in his earlier regime. To discuss the impact on Indian IT companies and the generative AI play, will the hype turn into actual revenues in 2025? We have Manik Taneja, Executive Director, IT Services and Internet at Axis Capital, joining us on the show. Manik, thank you very much for joining us today on the 31st. So tell us first, this H-1B news that we had yesterday, is it noise for you right now? Would you wait for the final guidelines or would you read something into it?
Thank you for having me on the show. I would say Indian IT companies have weathered some of these visa-related challenges in the past and are in a better situation compared to probably even say when Trump was elected for the first time in late calendar 16. That being said, certainly there have been some news flow about potential changes to the salary levels for H-1B visa holders. These things do tend to get passed on to the customers in general. And I would say this will be no different this time around. And thereby, at a net level, I don't see this as a big intent for the sector.
Okay. Manik, good morning. Thank you very much for joining us. More generally, what are you picking up on IT stocks? We saw Accenture push up its earnings expectation or range guidance. What's the sense? Are people recruiting more? Are your sources in IT companies talking about better orders, better execution? Will Q3 be better than Q2?
So at the outset, I would say typically third quarter does have lower number of billing days, typical December quarter phenomena. And thereby the third quarter performance may be sequentially weaker than second quarter in most cases, which is the usual trend. That being said, the sector essentially through calendar year 23 and calendar year 24 went through significant growth moderation, which was a function of multiple factors. Some of those headwinds are certainly receding, and given the optimism in the US going into calendar year 25 with the hopes that the new regime is also pro-business, certainly that optimism should feed into better demand backdrop. That being said, and thereby the rate of change for the sector essentially will be positive from a growth standpoint. As investors / analysts, the challenge that we face essentially is the fact that valuations for Indian IT are significantly higher than what they have been the last 3 to 5 years. In fact, most companies trade at premium to Indian IT companies. So our viewpoint has been to play the sector selectively when it comes to India listed names. At a more broader level, I would say global tech services companies offer better risk reward, a combination of lower than historical valuation multiples, lower valuations compared to Indian techs, and significant price underperformance over a 1 year basis compared to Indian IT. And they should also be significantly benefiting from a pickup in demand.
Okay, so your preference is for global tech companies versus the Indian tech companies. And I think your recommendations will also come up, or your picks will also come up on the screen. Wanted to get your thoughts in on generative AI. Now, you've come out with a very exhaustive report and you've titled it Millennium Shape Shifter to Transform Services. So in a nutshell, tell us what generative AI is likely to do in the near term.
So certainly that's the most I would say, most widely used term across management commentaries in the industry over the course of last 24 months now, since the time this came up. And the pace of development essentially is very sharp. From an Indian IT standpoint, the bigger question is that given the productivity benefits that one can have in the software development lifecycle, can these benefits be retained by Indian IT companies? Just to essentially highlight, Indian IT companies' commercial model have typically been effort based or billing for effort, and thereby the question is that whether with the benefit that these companies gain from lower effort, can these gains be saved? At least going by the history of the sector, and we've seen through the cycle with the way currency depreciated or some of the savings that that happened post COVID. Over the course of several years, these gains got passed back to the customer. The positive viewpoint essentially is that these companies can pivot from a services to a software model, but I think given the lack of proof, one would need to see as to how this evolves. For now, our belief is that most of the gains from GenAI will get passed on to the customers in the form of in the form of pricing or efficiency gains.
Okay. Manik, we'll have to leave it at that. Have a market to trade. Thank you very much indeed for giving us your thoughts on the IT sector, and have a good 2025.
Thank you.
It's 9:10. Thank you. It's 9:10. So Sudarshan, straight away, what is your 9:10 call? And more importantly, a question I missed asking you. You know, the IT and the Adani stocks are the best performers for the week. Is there any long trade there?
Yeah, good morning. See, Cipla is my 9-10 trade. Consider buying Cipla with a stop under 1495. I would avoid Adani stocks altogether. They're far more volatile to be bought and thought of in this environment. ID stocks are certainly buying on dip opportunities even now.
Okay. Thanks for that, Sudarshan. And of course, have a great trading day. We'll wish you a happy new year tomorrow. You will be with us. Let's get to Srikanth now. Srikanth, your 9-10 trade? Okay, Srikanth isn't with us. So I think we have Hormuz.
We do. We have Hormuz for some stocks you should have on your radar as we get ready for opening. Hormuz?
Beverages is one you should be having on your radar because Antique has come out with a note, a buy recommendation, a 710 rupee price target. It refers to the recent acquisitions that Varun Beverages has made in the African market, and it says that because of these acquisitions, the share of its international volumes post that will increase to 36.5% from 2026 from 19.5% that was in 2023. It also talks about the fundraise where it says that the QIP that they have raised through 7,500 crores to the QIP, majority of that will be used to service debt, and post which Varun Beverages will become a net cash company post the servicing of that debt. Now they are also expecting the overall volumes, revenue and EBITDA to grow at a 21, 24 and 28% CAGR over calendar year 2023 to 2026. And as a result, they have revised their 2024 calendar year EPS estimates lower by 3% and increased the same for the next 2 years by 10% and 3% respectively. Now interestingly, Varun Beverages is up 30% this year, and it has maintained its post-listing record of giving positive annual returns every single year since it listed back in November of 2016. Now, JSPL is the other one you should be watching out for. Nuvama met the management, and it says that it is in the process of resolving its pellet bottlenecks, and once that is resolved, it will increase its volumes by around 8.3 million tons in FY26 itself. Around about 3.5 million tons capacity is set to come on stream by the end of this financial year. And for the coal blocks, they are in the last leg of government approval, and mining should begin from the first quarter of FY26. But they are reducing their FY25 and 26 estimates by 6% and 4% to factor in the lower volumes. But regardless of that, they still have a buy rating on JSPL with a price target of 1292.
Okay. Thank you very much for that. But that's not the only stocks that we want you to keep an eye on. Abhishek is telling us to put microfinance stocks on our radar. Abhishek, tell us why.
Well, Lata, UBS has written on microfinance wherein they say that overdues are up 110 basis point month on month in the month of November. So they believe that elevated forward flow from early delinquencies buckets will result in, higher slippages in H2 FY25 versus H1 FY25. So portfolio at risk, that is par of between 1 to 30 days, is down about 20 basis point month on month. However, portfolio, at risk between 1 to 90 days NPS is stable on a month-on-month, except in few states like Bihar, West Bengal, etc. So portfolio at risk 90 plus days month-on-month has increased on a sequential basis, that is month-on-month across states. They expect the growth to remain muted in FY25 due to stress with respect to the asset quality and disbursals norms getting impacted from microfinance industry. So they believe that while this is net positive in the medium term, this would reduce liquidity for weaker borrowers, which could impact the near-term stress in this sector. So they remain neutral on Bandhan Bank, IndusInd Bank and AU Small Finance Bank. All of them have exposure to microfinance industry, while they prefer HDFC Bank, ICICI Bank, Federal Bank and have a sell on SBI as well as SBI cards. Back to you.
Thank you very much for that. Just waiting for markets to open. In pre-opening, it's suggesting that we're going to have another down day, 85 points lower. Some of the stocks you should have on your radar is ITC, because their demerger of the hotels business has taken a step further. The hotels business should be listed latest by 16th of February, because that's 2 months from the time the NCLT approval came through. That was 16th of December. So ITC should be on your radar. Adani Enterprises was a big mover yesterday. So we'll find out whether there's profit booking visible in that or there is a continuation. And the bell has gone, and the first stake on the Nifty is at 23,550. We're staring at a downtick of nearly 100 points at open. The sensex 2 is lower by 0.5%. Mid-cap index giving it company on the way down, 0.5% gone. The Nifty Bank is under pressure. So this is a decisively lower start. But again, volumes are on the thinner side, and we've just had a minute of trade. On the way down, you've got IT stocks. So in fact, the top 5 Nifty losers are IT names. So Tech Mahindra, HCL Tech, Infy, TCS, Wipro down more than 1%, extending up to a 2% loss. But remember, the Nifty IT index has had a good year after more than a 20% rally last year. Even this year, it's ending with about a 22% gain. So some profits are being booked on the last day. Adani Enterprises comes in for some profit booking. IndusInd Bank was the lone private sector bank which managed to close up in the green yesterday. So that's seen some profit booking, while ICICI Bank is a bit subdued. We'll pull up HDFC Bank and find out whether it's higher in trade. Nope, 0.5% gone on HDFC Bank too. So that's also stumbling on the last day of trade. On the way up, it's PSUs, BEL, Coal India, ONGC all up. Tata Motors is having a good start. Some of the other winners include metal names like Tata Steel, Hindalco. ITC, as we pointed out, is also up and about in trade. And Hindalco, where there is news, has also got a green start.
Well, actually, the markets have not, taken advantage of what would be thin trade and done any NAV management. As I was expecting, it's been down, as even Sudarshan warned us, that 23,600 could be taken today, and that will disturb the long-term, or rather the near-term bull trend in the market. So it's something he worried about, moving below the 23,600 mark. But at this point in time, it's not a big cut if you look at it in percentage terms. It's 1/3% lower. And there is still, of course, like yesterday, every chance that the market pulls itself by its bootstraps, if not anything, at least for NAV management. Just wanted to point out a few mid-cap stocks that have positive news going for it. Mazagon Dock is up about 2.5%. It's got some orders, as is RVNL. So both those stocks are up about 2 to 2.5%. ITI, I mean, there are no rules for this stock. It's a huge zigzag move. Pull up a 6 month for that stock and you will know what I mean. It was rising 15-16%. Today it is still up about 6%. So ITI is once again having a field day. Among stocks that are not doing well, Adani Wilmar is feeling the pressure of that big block deal in which Adani Enterprises moved out. Indian Hotels, my sense is feeling the pinch of competition. There is going to be a slightly stronger competitor in the form of ITC Hotels very soon. Competition on the field they have always seen, but on the stock market there wasn't any one big hotel stock of the level of Indian Hotels, and maybe that's why there's a bit of chipping off on that stock. And then there's Zomato, Geo Financial, Adani Total, Infosys, Adani Energy. I mean, a lot of the Adani stocks were up this week, and I think it's just traders riding up and down. So nothing much to speak about in terms of fundamental moves on those stocks. I think ITC should get a look in. ONGC, as Manisha was telling us, is likely to rise because we saw crude prices go all the way up to $74, and therefore that's having a positive impact. Oil India would likewise be positive. Now there is a little bit more green with Coal India, BEL, Nestle, SBI, JSW Steel, all of them somewhat in the green, but we are talking really narrow ranges at this point in time. The overarching color is red. Now let's see if we can change that.
The Easy Trip, that's the biggest volume trader, volume traded stock of the morning right now, and it's straight away opened down with a cut of about 8.5%. The volumes are very, very large on Easy Trip. So, watch for that. And two other stocks. One is Mazgaon Docks and the other one is RVNL, where there are order wins. And these stocks have opened up in the green. And Shriram Properties, where the company is monetizing some land, has got a green tick to begin trade with.
Okay. Well, those are the stocks to put on your radar right now. But at the moment, the markets having done their first thing in the morning, taken a red turn, still holding at 23,550 thereabouts. With that backdrop, let's invite our market master for the morning. Mihir Vora, the Chief Investment Officer at Trust Mutual Fund, is with us in our studio. Mihir, good morning, and thank you very much for cheering up our 31st by coming to the studio. We aren't the only two people working.
Absolutely. Always a pleasure to be here.
Yeah. Okay, well, for starters, I mean, we've lost enough from the 26,300 plus mark. Does the market look attractive at any level, or do you think you'll wait for dips to buy?
So let's keep today the glass half full day. Okay. The markets are still up 8 to 9%, right, on the Nifty. The small cap index is still up 25%, the mid cap index also. And it's been a wonderful year in terms of stock picking. If you look at the sectoral dispersion, on one hand, in a good market, in a bull market, you have the high beta sector, which is real estate, which did so well, 38% up on the real estate index. But in the same year, you also have the pharma index, which is up 35%. Yes. So a defensive is also up. A high beta sector is also up. So it's been a wonderful year for stock picking. And while the Nifty, which is the large cap index, is up 8 to 9%, you have the broader market, which has done really well. So I think if you just step back a bit and see the returns of the Nifty this year, they're kind of normalizing the returns of the previous year. The previous year, we had 17-18% returns on the Nifty. So now this year, we had single-digit returns. So kind of averaging out. So we are starting off with a good normalized base, I would say. We're not stretched in terms of overall valuations. Expectations are not that high at the Nifty level. Probably, yes, in some small cap, micro caps, there is a bit of a stretch. But in general, we are starting off with a good base. I think a boring year would be good.
I just want to put, what Mihir had tweeted a couple of days back, that 2024 is the 9th year of positive yearly returns. And this is the longest run of back-to-back positive years of returns since the inception of Sensex 45 years ago in 1979. That said, the current streak is the longest in number of years, which is basically 9 years, but the lowest in terms of percentage returns. Because in 9 years, we've only gone up 3x, while in the previous long stretches of returns, we've seen gains of 6, 7, 8% as well.
8x, yeah.
So what does it tell you, right? What happens after the markets run up 9 years? Do they correct over the next 3 years, 4 years? I mean, how should you view this data when you have a longer lens?
Sure. So I think it all boils down to valuations. Probably the markets have also evolved a bit. So maybe they are less volatile than before. Lot more institutional participation, lot more retail participation now. So to that extent, the markets have evolved. And frankly, the reason why probably we had this long stretch of positive returns, though may not be the best in terms of absolute returns, is also the fact that globally, after 2008-9, central banks have kind of backstopped the markets at every downturn, So to that extent, maybe it may be artificially propped up because of central bank actions, but that's the way it is.
Okay, let's speak about the mid caps, because that's what all of us are chasing, and that's where all the gains are. Do you think there the rally can continue, especially in really attractive businesses, not stock valuations, businesses, e-commerce, EMS?
Absolutely, and I'd kind of make a distinction between mid caps and small caps, because the way it is, we have kind of artificially defined the top 100 as large cap, the next 150 as mid cap. So technically, mid caps is only 150 stocks. But let's say I'm talking about the broader market, which is all the mid caps and small caps. I think that's where the real action is, because as the economy evolves, and we are evolving in terms of demographics, income levels, you'll see more and more segments like premium consumption, financialization savings, capex, infra, real estate, all those segments which are frankly not represented in a meaningful way in the top 50 companies. So the real stock picking chances are there. Government linked sectors like PLI linked schemes, those are the ones which are really doing well. And you can see it, the EMS theme that you mentioned.
Are there, not pockets, but large areas, swathes of overvaluation?
Overvaluation, it's a
EMS and e-commerce.
So that's the whole thing, and which is where our philosophy of terminal value investing comes into play. When a sector or a stock is starting from scratch, and if you see a 10, 20-year runway of growth for the segment itself, for the sector itself, then the top stocks in the sector will trade at a premium, will trade at a meaningful premium, because when you're starting at zero, the base can grow at 25-30% CAGR for 10, 20 years, which we have seen. For example, when the first private sector banks came in, they grew at 25%. They grew at 25-30% CAGR for 15, 20, 30 years.
So which of these sectors? EMS is one, defense is one.
EMS, defense. I think the whole of capex still has 5 to 7 years more to go minimum.
Because capex as well.
Because right now everything in the capex world has been propped up by government spending. We really haven't seen the private sector kick come in. Once that comes in, and who's going to make the factories for EMS or defense and all? It has to be based by capex, right? And again, stepping back, we say we want to compete with China, right? But China, Japan, Korea, at their peak and maintaining that peak for 10, 20 years, they were investing 40 to 50% of their GDP in fixed assets, in capacity, infra creation. We are currently at 30%, 32%. And China is 5 times bigger than us. So even today, China is investing $7 trillion in infra and physical assets every year compared to our $1 trillion. So we have a long way to catch up. And if China plus one becomes a reality even to the extent of 10%, we'll need to double our industrial base.
So the structural opportunities are capex, manufacturing, etc. But just for, say, 2025, those who like to play for 1 or 2 years, where are the opportunities, according to you?
So structural opportunities always remain the core of our portfolio. But tactically, I would say that financials, especially the banks and NBFCs, have underperformed.
In NBFCs, where?
In NBFCs, I would stick to the mortgages, the second-hand vehicles financing, the bigger ones. I would not really go down the curve in NBFCs even now. So the bigger NBFCs across segments look good, not so much on the unsecured loan part, because RBI is still keeping a close watch on the unsecured part. But the secured lenders, whether it's on the auto finance, truck finance, mortgages, etc., I would go for gold finance, I would go for on the NBFC side. But private sector banks are really attractive now in terms of valuations. And the reason why the banking sector underperformed is because credit growth came down. Now it's almost down to 10%. I don't think we can go lower than that in terms of credit growth. It can only go up.
And Reserve Bank is now in a
and valuations are attractive. Exactly.
Any others?
And that's almost 35% of the Nifty. So there's a big chunk of the Nifty which is looking at
large NBFCs, large private sector banks.
Absolutely. The second pocket I would say is certain chemical stocks which have underperformed for almost 2 years now because of China coming back and all. So that pocket looks good. Even
we have Vinati Organics joining us, so maybe you want to listen.
Yeah, and auto also looks good, again after having underperformed. I don't think a country like India can have suboptimal auto growth for too long a period. So last few months have been a bit suboptimal. That has to normalize.
Okay. Well, what's your sense about the underperformance in Reliance? Some of the big, why did Nifty not do as well as the mid caps? It's because many of these big boys did not perform. Other than banks, there are big stocks. Do you think that now they are at good valuations?
See, I'm personally not a big value investing fan. So we don't buy stocks just because they are cheap. And our view is that the global economy will not do as well as the domestic economy. So India, I would rather stick to stocks which are more domestic facing, because I think the domestic GDP growth will be structurally higher even for 2025 as well as structurally for the next 10 years will be higher than the rest of the world. So global cyclicals we are not very positive on, especially because of the fact that China, which is the largest consumer and producer of all these commodities and metals and all, is not growing as fast as it used to be. I think China has created all the infrastructure that it needed to, and more probably in terms of real estate also. So global commodities, I don't think we would be structurally bullish on. And that's the reason, why some of these stocks in the energy space, in the metal space are not performing. And that I think will continue to be a thing going forward too.
Okay.
And that's why the question mark on Nifty performance versus the broader market.
Doesn't consumption worry you? I mean, we've heard so much in Q2 about FMCG, and then Godrej Wonders, and then you saw the Q2 GDP numbers, consumption, and even how much more can even discretionary consumption go? Titan has not had a great year. So I'm just asking the entire consumption thing.
So discretionary, I don't think is a problem yet, in especially high-end consumption.
Hotels.
Hotels, airlines, jewelry actually not doing too badly. The structural dynamics of the industry is changing, but per se the segment is not growing at a suboptimal level. But everything, for example, liquor. Liquor consumption,
oh, yes.
the spirits companies are doing
it's
well.
It's been everyone's buy.
Yeah, so hotels, liquor, airlines, premium cars, premium real estate.
SUVs.
Premium real estate is rocking, right? So premium consumption is not a problem. So basically the discretionary theme. In FMCG, I'd say that things will normalize both in terms of margins as well as in terms of volumes, because the governments are spending now. All these state government schemes for the women, etc. They're actually some kind of an indirect UBI, universal basic income, coming in. So that should kick the consumption theme also.
What's very quickly and briefly, tell us what's the big global call that you're taking? Because we do get impacted by what happens, on the global front.
Sure. So the base case, and we'll talk about the risks to that base case. Base case is that it will be a normal year.
Okay.
So CY 2024, the global GDP growth was around 3%, expecting similar numbers for the next. US economy, which did very well, almost 2.5%, 3% last year, probably will slow down to 1.5 to 2%, which is fine. Corporate earnings are still doing well there. And for India, about 6.5% GDP growth. So that's the base case we are working with. So as I said, a boring normal year will be a good outcome next year.
Okay. And what are the sectors that you would completely avoid, at least as per the visibility that you have right now?
Avoid, I wouldn't say it may be a strong word, but as I said, global cyclical still, not very positive on.
So that's
we are still believe in the domestic story.
Okay. What about IT and pharma? And will rupee depreciation be a big tailwind?
So in IT, we are actually underweight the large caps, but overweight on the mid caps. The large caps, basically even a bull case, we are talking about a decent single-digit kind of a growth, not really trailblazing kind of growth. But there are niche mid caps which are doing much better and will structurally do better because of management changes, the niche segments that they work on. So IT mid caps is a good area for stock picking. In pharma, again, we are quite overweight, significantly overweight, not as a top-down call, but just because of the fact that we have so many bottom-up picks in the sector. Okay. So we are almost 500 basis points overweight in pharmaceuticals in our portfolios, and that's purely on a bottom-up basis. We are overweight on all the things like CDMO, even generics, healthcare, including hospitals, diagnostics. So across the chain, we found good bottom-up stocks. So it's not a top-down really call, but a bottom-up call.
Yeah, even for that matter, defense that you spoke about, it would have to be bottom-up, isn't it? Because valuations have also run up for several PSU stocks.
Actually, you need to then take a top-down call, because a top-down call would be a call for 5 years or 10 years, irrespective of the fact that the order books get delayed by a quarter or two, etc.
Oh, so you're still very positive on that?
Absolutely, absolutely.
Okay.
Because we barely scratched the surface on exports. And while there is a clear visibility of indigenization of production for the next 5 to 7 years, so that's going to double the industry size in any case if that comes through. But exports is something that can triple or quadruple the industry size because the global defense spending is $2 to $3 trillion.
A question that we get asked often is that can you go out and buy a Zomato and Swiggy? You believe in the opportunity, but the stocks have run up.
Absolutely.
So is this it is a long-term opportunity, but at these levels, would you recommend going out and buying?
So we are quite positive on the new age companies. We have a basket of stocks in the segment. And again, there the call is how big is the runway and whether it's a winner takes all.
But you must have gotten it at lower levels, right?
Yeah, that's fine, but we're not looking at 100% returns. We are talking about a 5 to 10 year runway for some of these stocks. And the fact is that in these situations, once you have that basic, subscriber base in place, it becomes an entry barrier. So it becomes a duopoly or a 3-player market, which is what we are seeing in a lot of these segments.
Okay, so even at these levels, it's fine if you have a long-term
Absolutely,
time.
because once you have the subscriber base, you can go for adjacencies. You can introduce newer services, as long as you have the basic data in place for the subscribers.
Finally, the other top-down buy has been power. Almost every aspect of power, from the Tata Powers of the world to all the transformers and,
Renewables.
T&D and renewables. Which part of the power space do you like?
So we are not so much on the utility side, but
Not the generators.
Not the generation, not the utilities. We are more on the EPC companies and the equipment manufacturing companies, both on the transmission space as well as on the distribution side, especially companies which are doing EPC and equipment for the renewable space.
You spoke about large NBFCs. We have a large NBFC, Shriram Finance, joining in. So what are your thoughts on this company in particular, and what are the questions that you would have for the management? Like, what would be the key themes for a company like Shriram Finance going into next year?
So obviously I can't comment on individual stocks, but probably one should ask the management about visibility of credit growth for the next year, because I think the funding crunch probably is anyway going to ease over the next few months because of the RBI's stance, and even the government is making some noises about slow down, etc. So you should see funding crunch ease in any case. So then the only thing remains to see is the top line growth. Maybe
Okay. Thanks a lot, Mihir, for a bunch of ideas that you have given us on what we thought was a holiday strained day. Thank you for dropping in our studio, and have a brilliant 2025.
Wish you a very great 2025, and to your subscribers also. And thank you so much.
Thank you very much. Okay, we were talking about, Reema was talking about Shriram Finance, and indeed we have the management with us. Umesh Revankar, Executive Vice Chairman at Shriram Finance, is joining us. Mr. Revankar, good morning and thank you very much. Apologies for the bad telephone line last week, and very nice of you to oblige us a second time. Well, as our previous guest was telling us, Mihir Vora, how do you see loan growth in 2025 and more particularly in FY26? Do you think it can be good, because we are seeing so many warnings on unsecured loans, consumption not doing too well?
Yeah, good morning. I personally believe that 25, 26 should be very good, mainly because, one of the main reasons why I feel there was a little slowdown in the pickup in credit was the infra spend by the government was much lower than expected. And that has a major impact in the consumption pattern and also the migration of labor, because a lot of unskilled and semi-skilled labor get migrated to urban centers for the job when there is infrastructure spent. That was a bit lower in the last 2 quarters, and it is picking up now. And that will have a major positive impact going forward in the next full calendar year. I believe next calendar year, the growth rate would be much better, and credit demand also will grow accordingly.
So do you have a range in mind, sir, for credit and loan growth next year? What are you targeting or hoping to achieve?
See, from Shriram side, we would be happy to grow anywhere between 15 to 20%. That is because we would always be very conservative in both planning and estimation, and but industry can grow. Industry may grow, especially NBFC credit, compared to what it has been in the last 2 quarters.
Okay. Well, we have to discuss the RBI Financial Stability Report. They are worried that loans, multiple loans are being given to the same person. They're often giving consumer durable loan and maybe a credit card loan to a person who has an auto loan and a home loan probably. Now, you will not be in the personal loan segment, but you may have given them an auto loan, for instance, but that person has multiple loans. How worried are you of unsecured loans?
See, when we look at our customer, when we lend the money, when we look at the credit bureau score checks, we normally see that our customers have no other borrowing. At the most, he may have some gold loan borrowing. Otherwise, he do not have multiple loans, is what we see. Because most of our customers are in the semi-urban and the rural market. They are not, typically they take the multiple loan is what because this is our data and what we have. And there may be some instances where there is a multiple loan. In fact, many of the lenders today would like to give the multiple loan from the same institution so that they have a better track of his cash flow and his ability to pay. Only when he has a different loan at different places, then we have a difficulty in tracking his income versus ability to pay. We try to put things in such a way that we are sure about he's having enough source of income to repay the loan.
Sir, are you increasingly seeing more competition in the CV lending space? Because, margins are more lucrative. There are reports that banks too are muscling their way slowly and steadily into this segment. So first, tell us, what has been the competitive landscape last year? How has that changed? And your view going into next year?
See, we have been in this industry of this lending activity for a very long time. The competitive intensity was always there. It is not that today the banks or other lending institutes are becoming active. We have seen depending upon the various economic scenario, many of people become active sometimes little passive. This is the way the management reacts to different situations. So competitive intensity is always there. I don't see there is a heightened or increased competitive intensity now. It has always been there. And if you are carving out a niche area for yourself, then you are very comfortable in the niche area you are in. So many of the NBFCs, they have their own niche areas and they play around that niche areas. I don't think there is a direct competition, especially in the among the larger NBFCs for a particular space.
Okay. Can you cast your eye over the next 365 days and tell us how will cost of funds pan out for you? Will it be lower than it was in 2024? And therefore, margins, will they be like 50 bips higher, 40 bips higher? Any guidance for the 2025 margins?
I believe the first 6 months, the margins and the cost of borrowing would remain almost same. I don't really see significant change, because even if there is some change in the policy rate to translate into or get into the NBFCs, when it passes it on to the NBFCs, it may take a while. So I believe it may first 6 months it will remain same. Post that, there is a possibility that the interest rates can come down a little depending upon the policy rates and the liquidity that being available. So I feel over the year, if I say the second half of next calendar year, there will be around advantages of around 25 to 50 basis points. Overall net interest margin for us would remain same. I don't really see big difference, because whatever the benefit we get, we'll pass it on to the customer.
Yeah, and actually, Abhishek has given us a nice table of the NIM performance of all the big NBFCs, and all of them have dropped by about 10 basis Q2 over Q1, whereas you all have dropped only 5 basis. So do you think 8.75 is something you'll manage?
No, we'd like to be in that zone, but anywhere between 8.5 to 9 is a good zone for us. Okay. We would prefer to be around 8.75, that's the midpoint. And we are just hoping that we'll be able to manage it for next couple of quarters.
So 15 to 20% growth, top line growth, and margins between 8.5% to 9% is what you're hoping for next year. Any fundraising plans?
The fundraising for us is a continuous, because it's the raw material we need. So we are, so one thing about Shriram is we always been looking at new source, so that we are not over dependent on one single source. So the resource raising in various sources, or trying to see a new source which is likely to be more liquid at any point of time, is the our senior leadership has been trying to find it out all the time. So this is always there. So we are quite comfortable now. We have raised recently a large sum. You have noticed that we have raised 1.27 billion in the recent times. So we are very comfortable as far as the fundraise is concerned now. We are not really looking at any immediate fundraise.
Okay, just one more number. Your bad loans GNPA ratio. Again, you all were the only ones who brought it down, Q2 over Q1. Everybody else saw some 10 basis points increase. Are you sure with all these Reserve Bank warnings, you remain below? I mean, will it go down from 5.32 to 5.3, 5.2? Is that the direction?
See, we actually targeted to reach 5%, but depending on the economic environment and situation, it can vary. We are quite comfortable at 5.32. We feel like we have done a very good job, and we'll be happy to maintain at this level for some time.
Okay. Oh, certainly it's an outperformance compared to your peers. Mr. Revankar, it's always a pleasure having you with us. Thank you very much for giving us a macro and micro understanding of Shriram Finance in the NBFC space. And here's wishing you a brilliant 2025.
Yeah, wish you happy New Year.
Thank you. Well, at the moment, not too much happiness in the stock market if you're a bull. Mid-caps in particular down 0.7%. Likewise, actually, the sensex nifty are also down 0.5%. Advanced declines are seriously in favor of declining stocks, 1.5 declining to 1, or rather 3:2. Time to take break. But as we step into 2025, CNBC TV18 is asking some key questions. How will the Nifty perform in 2025? What are the sectors, themes to bet on? Will the faltering GDP growth revive in 2025? Will the Reserve Bank start cutting rates in the coming year? We will ask all the experts on behalf of you. Stay tuned in for the most comprehensive market poll tomorrow on CNBC TV18.
Welcome back. You're watching Corporate Radar. Now, Vinity Organics is the next management on our show now. It's been a sort of a challenging year for Vinity Organics. This year, the stock hasn't given any return, absolutely flat in 2024. But going ahead in terms of growth fundamentals, the company has indicated that they are aiming at a revenue growth of 20% CAGR over the next 3 years, fueled by ATBS, antioxidants, and other products. Vinity Saraf Mutreja, Managing Director at Vinity Organics, now joins in. Vinity, if in a very brief manner, if you had to recap 2024 and the kind of challenges and opportunities you faced, how would you do that? And what would you be looking ahead to if you had to focus on the top 3 things on the board's mind for 2025? If you could lay that out for us.
Sure. Good morning and wishing you a happy new year in advance. I think you have pretty much summed it in your opening statement. 2024, though I disagree to some extent, at least from an operations point of view, I wouldn't call it a challenging year for us. We have grown in, if I look at FY25, to almost 15 to 20% compared to FY24. Of course, FY24 was a low year in general for the chemical industry, with a lot of destocking happening and a lot of overpurchase happening in FY23, and that has normalized this year. And going forward, coupled with our existing expansion of our existing products like ATBS, as well as the new products that we are adding in viral organics and the antioxidants, I do expect a 20% growth in revenue in FY26 and FY27, so on.
Okay. Vinity, good morning, and thank you very much indeed for joining us in a holiday-thinned week. Your Q2 numbers were very strong. There was a margin expansion from the previous 22.6 to 24.2%. But, your previous bests are 25, 27% as well in FY23, if I remember right. You think FY26 can be that year when your margins can go back to what you gave us a couple of years back?
Yeah, see, actually the margins are a bit slightly lower in Q1 because a lot of the sales got spilled over to Q2. So if you look at the average margin percentage of H1, it should be somewhere around 25-26%. And I expect to maintain the same margin around 26-27%, even maybe in second half, because historically speaking, second half is better than H1. We do see sales, lot more sales pick up in October, November, and similarly in Jan, Feb. So in FY26, I think given our revenue mix, maintaining a 26% EBITDA margin looks very reasonable.
Okay, no, I was calculating OPMs, and for me, your first half came at 24, not at 26. But it was OPMs. I was not calculating EBITDA margins.
Yeah, maybe I'm including the other income and you're excluding the other income. I think that's the difference.
Okay. So when I meant challenging year, I meant from a stock point of view because, the stock over the last 3 years hasn't given any return. So not just 2024, over 3 years, I think there's been a little bit of a downtake in the, the stock price. But take your point forward that 20% is the kind of top line growth that you expect. Can you give us an update on your expansion plans? I think you've spoken about 550 crore of expansion plan. Is it on stream? Is it, is it going to come on stream at the same time, scheduled time? Is there a delay? And just talk to us about that.
So the expansions are on track. Our new line for ATBS should be ready in the next couple of months, and we expect revenue growth coming from that. Similarly, so that's about 300 crores of capex, which has been done there. Another 500 crores capex over 2 years will happen in our subsidiary Viral Organics, where we have already started some products, monomer inhibitor, as well as a pharmaceutical intermediate, and we're adding 3 new products in that, which is again, one is skincare intermediate. The other 2 are, one is used in the agro industry, tertiary amyl alcohol, which we will be making from isoamylene, as well as we will be backward integrating into anisole, which will start in FY26. And from anisole, we will again be horizontally integrating and adding another food ingredient called BHA, which again uses 2 of our existing products, isobutylene. So the expansions, the product mix, everything seems to is on track from our perspective.
This expansion was scheduled for January 2025. Is when you're saying couple of months now. So is there a bit of a delay?
ATBS will be ready by March, April 2025.
Okay.
Yeah.
Okay, just one word. So you had given us, of course, 26-27% EBITDA margins. Guidance on top line was 20%. You stick with it or improve it?
Yeah, no, we stick. Maybe I just to be safe, I say 15 to 20%. So 17-18% we should achieve. Again,
okay, 15 to 20.
Yeah. Price fluctuations matter. Yeah.
Yeah, price fluctuation. That's exactly what I was coming to. One of the problems besetting the industry, not just you, have been the Chinese pricing. It was obvious in the antioxidants. Now, it could get worse as China faces tariffs in some countries. It's probably going to be dumping more. What's your view of 2025 pricing, and will there be pressure on some of your chemicals?
I think as far as the China problem is concerned, I do believe the government is intervening, and you see that in a lot of other sectors as well as in chemicals. They are imposing anti-dumping duties and all sorts of duties against China, which is a must because in a lot of chemicals, they are selling below cost. And given the subsidies that their own government is providing them, and hence the pricing disparity. And so we do, in antioxidants, we do expect some government help, and so are other chemical companies. Going forward, I do feel India has an advantage given the tariff conditions in China, given our cost of production. I still feel the overheads are lower in our country, and together as a public-private partnership, overall the next 5 to 10 years, I think the chemical industry is set to grow in India.
Okay,
sorry. How much percentage, or which are the products that directly face Chinese heat? What percentage?
For us, it is primarily antioxidants, which is today about 10% of our revenues.
Okay.
I do hope next year, as the sales pick up, it should increase to 20%.
Okay. This 20% revenue growth in FY 25, 26, 27 is taking into account the increased capacity across your various plants, or is it before the capex comes on stream and capex will boost it further?
No, it's taking in first. It's taking into account the existing pricing conditions. So I'm not accounting any pricing change. So it's purely volume growth. Now the volume growth will come from most of the capex which we've already done in the new line of ADBS as well as in Viral Organics in the new products which some have started and some are about to start in FY26 as well as the antioxidants where we have the capacity and we're just hoping the market situation to normalize.
Okay. Well, we'll have to leave it at that, Vinati. Thank you very much indeed for joining us. You are a superb entrepreneur. Thank you for joining us, and here's wishing that your 2025 brings you more successes.
Thank you very much.
Okay. Well, maybe we want to cast just a quick eye on the markets because now the mid-caps are going into a 1% downtick. And that's always a bit of a dampener for Indian investors who have been more of mid-cap chasers rather than large-cap investors. It's not as if the large caps are doing much today. They're down 0.5%, but the mid-caps are racing to 1% downtick, and that's moving the BSE advanced declines to 2:1, 2 declining for 1 in the green. So not a very happy state of things as far as we are concerned with stock markets at this point in time. Things can turn, if you remember the yo-yo market yesterday, but nevertheless, it's something to worry about. With that, let's invite the next management. Supriya Life Sciences stock surged more than 122% in 2024 so far. To discuss more about demand trends and expansion plans, we are joined by Satish Wagh, Chairman and Whole-Time Director at Supriya Life Sciences. Mr. Wagh, thank you very much indeed for joining us. Well, first up on revenues in FY24, your revenues were 570 crore. First half FY25, 363 crore. Can you give us some idea of when you are looking at the perfect 1,000 crore number? What's the revenue growth for this and the next year?
Good morning. See, as we have always promised that we will do definitely 22% growth year on year. So we will definitely do that. We have recently launched one of our a big block, which is almost 575 KLD, and it will increase our capacity. And this, we have invested 120 crores. The production in this area have already started. Qualification are ending, and we'll definitely produce here some of the products which nobody is currently manufacturing in India. We always use the chemistry for manufacturing against China. We will be manufacturing here some of the products which are currently being manufactured for last 25, 30 years by China only. And that will be a big dent as far as Supriya Life Sciences is concerned.
Okay, which are these products, Mr. Wagh? And I mean, as we were discussing with our previous guest, there is a big fear that China would be, I don't want to say dumping, but will certainly be coming with aggressive pricing because some of the markets could be closed to them like the United States. So which are the products and what kind of pricing competition do you expect to face from China?
As far as Supriya is concerned, if you see out of 100%, 89% is our exports, the remaining is our domestic. We have always been very strong against China. We have a good chemistry and R&D center which develops good technologies. Now I will tell you the first product, which is a very big mega blockbuster, which is atorvastatin, which is being used as far as therapy is concerned for heart. Everybody imports from China ATS-8, which is 600 tons. So we have decided to manufacture this intermediate from the basic, that is ATS-2, ATS-3, 4, 5, 6, 7, 8, and even N-1. The capacity is designed almost 650 tons to take care of India and our exports. We have no worry at all as far as China is concerned. Even they dump, we have good process and the fully automated plant which will be on the operation. We are also using somewhere the latest technology like flow chemistry. We will definitely scale up new products. That is the same product is suoflurine, which is the anti-anesthetic. If you really see, there are only 4 manufacturers who are catering the world from China, and all are non-GMP plants And currently, this material comes to every manufacturing in India, though they are non-GMP, but we'll be producing all these in our US FDA plant.
Okay. Sir, 22% guidance is for the current year, but do you think the company is designed for a 20-25% revenue growth sustainably over the next 3 to 5 years? Do you think investors who take a long-term call can expect a 20% plus kind of a top-line growth?
Ma'am, I can definitely tell you that we will definitely achieve is the two products if you see. The first is ATS-8 currently being sold at $75 per kg. You can imagine 650 tons capacity, US FDA plant, not a non-GMP plant. The suoflorin is also the same. It is currently being sold by China at $75-80. Our capacity is 275 tons. So if you just calculate, you will understand that we will definitely achieve our goal.
And the goal, sir,
more
is?
than that, but I assure you that we'll do it.
So the goal is, Mr. Wagh?
I can't give you the figures, but initially when you ask, when you will cross, is this the figure? So that figure will definitely cross.
Okay. What would be your penetration? Okay, just a minute. That's the Unimec Aerospace listing, and what a fabulous listing. 80% higher. The stock is open at 1,416. The issue price was just 785. The company had raised 500 crore rupees. Of that, 250 crore was a fresh issue and an offer for sale of 250 crore rupees. But the promoters said that the offer for sale is to bring down, the promoter holding, for the listing. This is a company which, provides certain precision components in the defense and aerospace segment. So it's a hot space. Many of the companies in this particular segment have done very well. And it's the last listing of 2025. And what a fabulous listing, 80% higher on Unimec Aerospace. It's a small company. The company's top line growth last year was just about 200 crore rupees. EBITDA margins were at 37.9%, but margins for the company have been steadily expanding. From margins of 21% in FY22, margins have expanded to 40.5% in FY24. And the company is also seeing a pretty strong growth on the top line too. In FY24, the revenues had doubled from 94 crore to 200 crore odd. And in the first half of the year, the company has done about 121 crore of a top line. Small company, but a bumper listing. But getting back to our conversation with Satish Wagh of Supriya Life Sciences. Sir, the street is also looking forward to how you will increase your penetration in regulated markets like Europe, Latin America and Japan. So what is your current penetration here? And in the next 3 years, how much can you increase it by?
Ma'am, as I told you that our exports are 89%. Out of that, 57% is Europe.
Okay.
After that, we go to the Latin American countries. And slowly and silently, we are moving in US also. We have another plant also which is coming up where we have invested 130 crores. That means you can understand we have invested 250 crore. The first plant at Ratnagiri at Chiploon has already gone on stream. The another one at Ambernath will also go on stream within another 30 days. And these two manufacturing sites will give a boost and the strength as far as our sales are concerned.
So US, what could be the revenue contribution from US in 3 years?
We will definitely be with US roughly around about 10 to 15%. But major exports will be in Europe. And
yeah, you
that
said.
is our...
So margins should increase from current levels?
Yes, definitely. The first strong point of Supriya Life Science Limited is it's a debt-free company. We do every expansion, everything from our own pocket but revenue which we are earning.
Okay. Thank you, Mr. Wagh, for joining in and wish you a very happy new year. It's been a good year for all the shareholders of Supriya Life Sciences as the stock moved up more than 100%. We'll get into a break. On the other side, Manisha Gupta will join in to talk commodities. Stay tuned. Welcome back. 23,500 on the Nifty, down more than 100 points. So still no respite for the markets, pretty much at the day's low. Vinay Rajani, Senior Technical and Derivative Analyst at HDFC Securities, is with us on the show now. Vinay, 23,500 is an important support for our markets. So, how important is it? What if it breaks, and what would be the trade?
Yeah, good morning and thanks for having me on the show. So definitely 23,500 is a very strong support. It happens to be the previous swing low and it seems to be breaking that level, and the previous swing low was around 23,263. So I think it is marching, index is marching towards that level, and small cap index is also showing some weakness and breadth has been negative. So FIs have been continuously seller. They have been selling into index future as well as the cash market. So the long to short ratio of FIs have in index future has gone to 0.17. So though it is oversold, but still the momentum is there. Nifty has broken down below the consolidation which was there for last 4 trading session. So it's a typical flag pattern breakdown on the charts. So 23,500 needs to be tracked, and if it is sustaining, we are tracking that level closely. If it is sustaining below that for next half an hour, then it is definitely a weak. So markets are precariously poised right now and headed for the lower level. So I think the next support is around 23,200 odd level. That is also a retracement levels as well as the previous swing low. So yes, the outlook for the market is on the bearish side, and Nifty should be held short with a stop loss of, let's say, 23,700. Unless that is taken out on the upside, we are asking our clients to hold the short positions.
Okay, short on the Nifty, and the support now is 23,200. Stocks, Vinay?
Yeah, so basically healthcare and pharma, these are the sectors which are actually outperforming and have been showing resilience performance. So yes, definitely there could be a stock specific bullish momentum in healthcare and pharma space. So Sun Pharma is looking stronger to me. I think technically it is looking very strong, and 1887 is the level where one trader can take entry, fresh long entry, 1887. I would suggest a stop loss at 1850. On the upside, I'm expecting a target of 1950. On the sell side, I would go with the ICICI Bank. ICICI Bank has given a fresh trendline breakdown. There is also a flag breakdown on the daily chart. So ICICI Bank can give a short trade. So January future can be shorted around 1290. Stop loss can be kept at 1310, and target can be seen at 1260 next couple of sessions. So one on the short side, which is ICICI Bank January future, and one on the long side, which is Sun Pharma.
Thank you, Vinay, for joining in. Now let's go over to Manisha, and she's going to tell us the one commodity that's on her mind today. Manisha.
Thank you for that. And that commodity is silver. And last day of the year, but we still are looking at a lot of action onto this one, with the volumes may be lower, but we still are looking at year-end winding down on positions. For the silver prices, we've seen 1.5% of decline in the overnight market. It's fallen below $29 an ounce, and it's trading at a 3-month lows at this point in time. For this year, on the higher side, we've seen in the international market, silver prices hold around 34.5, and the lower side saw 19, but we are trading at around 28, 29 at this point in time. There are some reasons of this decline. One, the hawkish US Fed statements, uncertain industrial demand outlook going forward really seems to be weighing on to the markets. The second point is the overcapacity in China when it comes to China's solar panel industry, and the kind of tariffs that US perhaps could lead to also seems to be curbing a bit of a demand in the international markets. So China is going down when it comes to demand and production of solar panels. The third point is about the yuan devaluation. Remember, silver demand from China has been strong, but with the currency being devalued and China's loose monetary policy, that continues to weigh on many of the industrial commodities, silver being one of that. The fourth point is the weaker growth numbers that we have seen outside US. That's a bit of a concern as well. And add to that the fact that you are looking at strength in US dollar index, the higher yields, that has continued to weigh on many of these commodities. And then the speculative short position seems to be increasing as well. Markets have seen in India, 1 lakh rupees a kg when it comes to silver. But from those kind of levels, we are trading at around 88, 89,000 here. So there has been quite a bit of a sharp decline. But for the coming year, the expectation is that while it's going to be a volatile year, but the targets on the higher side have still bounced contained. JP Morgan, for one, believes that you could be looking at $38 of silver. Remember, we're trading at 28 right now. So that's $10 off a jump up that JP Morgan and UBS believe in too. Bank of America is not so bullish. 35 is the high of this year, and that's what they're sustaining for next year as well. Citi is the most bullish in silver. $40 an ounce is what they're anticipating in the next year. Again, we did see all-time highs, but from there, it has been nearly 18% of a profit taking in case of silver prices. Continues to decline on the last day of the year as well.
Okay. That's very interesting, Manisha. So, continued bullishness on the precious metal. Thanks a lot for joining us. Well, on the stock market, I do not have such bullish things to say at this point in time. I'll put it to, weak trades, weak volumes, and therefore big impact even of low volume trades. But it's 1.2 down on the mid caps today. That hurts. NAV management is not going to be easy. Almost 1%, 0.75 down on the big indexes, 0.85 on the sensex, actually. Banks are relative outperformers. They are down only 0.5%. But it's not a good day at all. I wanted to ask about Easy My Trip. But before that, Vivek has some interesting info on Ashok Bilkon. Ashoka Bilkon first, Vivek. And then I want your details on the Easy My Trip deals as well. But first, Ashoka Bilkon.
Well, Ashoka Bilkon, the news came in just prior to market open, so we'll address that first, given the fact that we've just had a chance to look at the deal and analyze what exactly is it that the company has done. First up, so the company as well as its subsidiaries, which held 11 SPVs, 11 special purpose vehicles, which had assets that were part of the HAM portfolio, the hybrid annuity model portfolio. What the company has done is the company has bundled all of these assets together, and they have sold these assets to funds that are managed by Edelweiss AAA, which is earlier known as Edelweiss Alternative Asset Advisors. What is the valuation at which this particular deal has been done at? The stake sale has been done at 2324 crore rupees. Now, what is pending for this particular stake sale to consummate? There is approvals pending from SPV lenders, NHAI as well as CCI. So, as per analyst estimates, this particular stake sale has been done at almost 2 times the original investment. So it's a positive at the margin as far as Ashoka Bilkon is concerned. Just a little bit about the assets. All of the assets have already reached the commercial operation date, barring one asset. So overall, a positive deal as far as Ashoka Bilkon is concerned.
Okay. Well, on a good day, perhaps the stock would have been in the green, but at the moment, it's just reducing its shade of red. Vivek, Easy My Trip.
Well, Ease My Trip today morning, we told you about how one of the promoters, Nishant Petty, who held just around 14.2% stake in the company. This was after he had earlier paired his stake in September 2024 by almost 14%. So he had half the stake in September, and we had understood from our sources, and we also had access to the term sheet where we understood that he was looking to trim or pair out his entire stake in a block deal that was supposed to happen today. But as per the trade window that we had a look at, it appears as though only 1% stake. So out of the total 50 crore shares that was expected to be sold in the block deal window, only around 5 crore shares have actually passed through. There is significant pressure on the stock, down almost 9%. Remember, the base price for this particular deal was at 15.6. So the stock is now trading almost at those levels, but it does not appear as though the entire deal has gone through. We will get confirmation and clarity on the exact quantum of stake sale once the block deal, bulk deal data comes out in the evening on exchanges.
Okay. We'll keep coming to you, Vivek, to explain this deal and, of course, the dynamics happening in the company's management. But at the moment, the legend at the bottom of the screen is telling you the somber news in the stock markets. Nifty plumbing near-term depths, gone below the 23,500 mark, which was held up as a support level. That support is gone. The next support level, my friends in the market tell me, is 23,300. In fact, that's been a level which people have been talking about. 23,300 to 24,300 was believed to be the move, the playground of the Nifty. We are very close to the 23,300 mark, but well, I don't see it getting pierced now. Anyway, a somber day as far as the bulls are concerned. Let's see if they can make a match of it in the remaining 5 hours of trading. For the moment, it's a break. Thereafter, we are going, of course, macros. We're going to check out in our special segment, It's the Economy. We're going to check out if the capex cycle has picked up well and truly for the private sector as well. I'll be speaking to Mahesh Vyas of CMI and DK Joshi, the chief economist at CRISIL.